Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. It is Wednesday, July 17th. We are going to take a look at one out of the information technology sector, Applied Materials. Let's jump right into the video. Now, before we get too far into the video, if you are new to the channel or perhaps a person who has been watching the channel and just haven't done so already, if you could do me a favor, hit that thumbs up button down below if you find any value in this content. If you are a dividend growth investor, make sure you are subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. Hit that notification bell so you're notified whenever we put out any new content. I do subscriber suggestions or viewer suggestions. If you have a company you'd like me to cover, like Applied Materials, go ahead and drop it down in the comment section below. Just another reason to make sure you have that notification bell clicked so you're notified whenever we put out any of those new videos, including one that you may recommend. I really appreciate everyone out there who has taken the time to do that. Over 1,000 subscribers now. The next stop is 5,000 subscribers. So help me get there. Let's get there faster than we got to 1,000 subscribers. I know that about half of you, a little over half, closer to 70–80% of you out there that watch the videos are not subscribed. So it just takes a second. It doesn't cost you a thing, and it really does help out a small YouTube channel like mine with the YouTube algorithms. It helps to spread the videos further and get the word out. In my opinion, the best way to financial freedom is dividend growth investing, and that is what we cover on this channel. Now, this is the vested interest stock screener. This is how I look at a company on a high level to see if it is going to make it onto my watch list. Thousands of companies out there in the market. This is a quick screener that gives me an idea of whether or not the company is worth doing more of a deep dive. So it's initial screener. It does not mean that I am investing if it does meet 5 of 8. If it's a financial company like a bank or an insurance company, I throw in price to book, and then it must meet 6 of 9. We're going to run through this criteria at the end and see where this company falls. And again, if it meets the criteria, 5 of 8 in this case, it would make it onto my watch list. And I would do more of a deep dive into the financials of the company, looking at the balance sheet, the income statement. We'd look at stuff like debt to equity ratios, assets over liabilities. Is their revenue growing over time? Are they paying down their debt? Are their margins expanding or contracting? Is their revenue growing over time? How are their sales doing? That sort of thing. Really get into the nuts and bolts of the company and how it looks financially. And then we do a discounted cash flow analysis and see what price range we're willing to pay. And then, and only then, if it meets the other criteria, do I invest in the company whenever it finally gets down to 15% of a 52-week low or in line with the cost basis I'm willing to pay. So don't blindly copy this screener. Tweak it to your investing strategy. We're all at different ages and stages of our investing lives here. So some of you may be younger looking for more growth. Some of you might like different criteria in an initial screener. That's fine. Tweak it to your liking. Make sure you're doing your own deep dives into these companies and not blindly trusting anyone on YouTube, including myself, because I am not you, and I am in my mid-40s. Again, a lot of us are of different ages and different stages in our investing lives here. So your investing criteria might not be the same as my investing criteria, and that's okay. Now back to the video here. We are talking about Applied Materials, and check them out at www.appliedmaterials.com. That is their homepage. That's www.appliedmaterials.com. That is their homepage where I pull this information from. And this is an easy one. They are a semiconductor company. That's what they make. That's what their bread and butter is. Semiconductor and display equipment company. 26 point, and they're the world's #1 is what they say. 26.52 billion in revenue, 3.1 billion in research and development, 34,000 employees in 150 cities and 24 countries. And that's important. 24 countries means that they have a footprint outside the United States. So whenever they have a little bit of trouble here in the US, things might slow down. Maybe they're still going strong in other places. And 19,600 patents. That's some high notes on this one, but again, out of the information technology sector, primarily semiconductor and the displays. So that's the displays on your screen that you may be watching it, whether that's a cell phone or on your computer there, as well as the semiconductors inside those same devices. They may be one that Applied Materials made. Now, the reason we were taking a look at them, down 10.48% on the day, huge drop on the day, closed out the day at $220.07. We are talking about Applied Materials Inc., ticker AMAT, out of the information technology sector. 52-week range as low as $129.21, as high as $255.89. So they are, even with a 10% drop on the day, they are still slightly leaning towards their 52-week high, and they are not within 15% of a 52-week low. A market cap of $182.212 billion, so they are a large cap company. A beta of 1.55, so they are more volatile than the overall market. You can see that volatility, although that's not really a lot of volatility. That's pretty much just a nice slope down throughout the day, except right here at the end of the day, it looks like they tried to recover a little bit. Looks like they're down a little bit in the after hours as well, at least whenever I pulled this information. PE ratio 25.3. That does seem elevated, but to be honest with you, with fast-growing tech companies, that's not outlandish, right? $25.30 per share, according to the PE ratio, is not terribly high for fast-growing tech companies, and this would fall under a fast-growing tech company. So a bit of a pullback here. Obviously, we'd like them closer to their 52-week low with the lower PE. The market right now is around 23 or so, somewhere in there. EPS sitting at $8.70 per share. Earnings date May 16th. So tune into that or check that out if you want to see how their earnings went back in May. Their next ex-dividend date is August 22nd. So we've got some time for that. So you would be in line for their next dividend payout. And that date will be 9/12, so September 12th here. So a ways away for the next payout here. Forward dividend is $1.60 per share. They are a quarterly payer, so you can do the math over here. We'll see that here in a little bit. 0.65% dividend yield. Very, very low starting dividend yield on this one. You are not buying it for the dividend yield right now. You are buying it for price appreciation as well as dividend growth if they have any. We'll see that here in a little bit as well. Ex-dividend date, again, August 22nd coming up with a payout in September, and a one-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $247.98. So they see it going back up, but not quite getting back to its 52-week high over the next calendar year. Now we're going to jump over to the statistics tab. If you were to go to Yahoo Finance, you'd click over here on the left, you'd find the statistics tab. Go down to dividends and splits. We're going to look at dividend yield theory. We're going to look at their 5-year dividend yield average. We compare it to their current 0.65, their 5-year average being 0.99, their current being 0.65, or over here where it said forward, 0.65, same number. And since it is lower than their 5-year average, that speaks to overvaluation. These numbers are inversely correlated. So being lower means overvaluation. If this number was higher than their 5-year average, that would speak to undervaluation. So right now, at least according to the dividend yield theory, this one is potentially overvalued. Very, very low payout ratio on this one, 14.71%. That gives them a lot of room to continue to raise this dividend over time, pay down debt, make acquisitions, reinvest back into the company. So very, very low payout ratio. I like 75% or less. So this is extremely low with a lot of room to go here. Now we're going to jump down and look at free cash flow. We want growing free cash flow over time. Typically, if a company has growing free cash flow, they have growing dividends to match. 2021 here, you can see $4.7 billion. 2022, 4.6. Now it looks like a little bit of a drop there, but we'll check out repurchase of shares here and see if that makes up for it. 2023 up to 7.5, big jump up in 2023, and so far in the trailing 12 months they're at 6.8. And now so it looks like they might be in line with where they were at 2023, but we need to wait and see how the rest of 2024 shakes out, because TTM stands for trailing 12 months. That would include part of 2023 numbers, right? Keep that in mind. So it's what they've reported so far in 2024 plus part of what they reported already in 2023. Now, repurchase of shares, I want to look at that as well. They are consistently repurchasing their own shares. 2021 here at $3.7 billion. 2022, you can see here $6.1 billion. So even though it looks like they dropped down in free cash flow, they almost doubled their repurchase of shares. So that more than accounts for that drop. So I'm going to call that growing free cash flow. And same thing in here, growing free cash flow, not only growing free cash flow, but still repurchasing those shares at $2.1 billion. And it looks like they're going to continue that effort in repurchasing shares into 2024, though, again, we'll have to wait to see how it shakes out. I am going to give them nice growing free cash flow here, consistently growing. Again, we'll have to wait and see what 2024 shakes out at, but right now it looks like they're going to be in line at least with what they did in 2023, if not a bit of a tick up here. Now we're going to jump over to stockanalysis.com, another site that I like to go to for information. You pick any sites that you want. Just make sure you're not just blindly trusting one site, solely one site. Make sure you're looking at 2, if not 3, to make sure the information you're getting is accurate and up to date. Now they have 25 analysts that look at this. That's quite a few, and they call it a strong buy, right? So if you were to go to stockanalysis.com, you'd be able to click on how many might call it a strong sell, a hold, a buy, or a strong buy. Based on this, there's not a lot or any calling it a sell or a strong sell. Most would be in the hold. Actually, most would be in the buy, strong buy, maybe some in the hold range. But overall, out of the 25, the majority are calling it a strong buy stock right now. Now they have a low estimate of 140, which would be a 36.38% decrease from where it currently sits, and that would be in line with 15% of their 52-week low and a much better starting price in my opinion. Average estimate of $223.84, which would be a 1.71% increase from where it currently sits, and if it happened to hit their high of $300, that would be a 36.32% increase. All the while you could collect that 0.6% dividend yield. Now we're going to jump into statistics here and look at how efficiently this company is reinvesting its capital. To do that, we look at return on equity and return on invested capital. I like 10% or better for these metrics. Return on equity sitting at 43.60%, smoking high. This company does very well with its capital. Return on invested capital at 28.43%. Again, over almost 3 times what I'm looking for, over twice the 10% I like. EPS growth, I like 5% projected over the next 5 years. Again, twice what I'm looking for there at 12.30, with revenue forecasted to grow at 7.52%, which is very good overall numbers. Really, the only thing that I don't like right now is this $220 starting price per share here. Let's wrap this one up and look at the dividend history. Quarterly payout ratio, again, very low. They're saying 18.39. I think Yahoo Finance had it in the 14 range. Either way, under 20%, so still very, very low. Extremely high dividend growth, 24.14%, smoking high. Growth years, 6 years of growth, buyback yield 1.3%, so they're efficiently buying back shares. Shareholder yield of 1.99%. Going back in time here, you can see 2022 in February, they were paying 24 cents per share. They raised it up May of 2022 to 26 cents per share. They raised it up May in 2023 up to 32 cents per share. And most recently, May 2024, they raised it up to 40 cents per share. I wouldn't expect another raise until May of 2025. Nice steady dividend growth here. They do pay out on the March, June, September, December timeframe like most companies do. Let's jump back over to the screener and see where we sit. Understand the business, check there. They all get a check there. That's where we start. We start with understanding the business, and unless it's a very complicated business, you should be able to understand what they do, what they sell, what they're making, how their revenue is being made. Growing free cash flow over the last 4 years, I've been giving them a check there. Growing dividend, yes, it's growing by over 20%. Dividend payout ratio under 75%. It is under 75%. It's down under 20%. Dividend yield theory says it's potentially overvalued, so no check there. It is not within 15% of a 52-week low, and it is not in my portfolio, so it can't be below my cost basis. No check on either one of those. Return on invested capital, return on equity over 10%, both check there. Earnings per share growth, yeah, it's over 10%, so check there. So we're looking at 1, 2, 3, 4, 5, 6 of 8, so definitely beats the metrics that I'm looking for. And this one is on my watch list. I am just waiting for more of a pullback on this one. I would love it under 160. Back in the 140s would be awesome. We'll see if it gets there. Well, that is really it for Applied Materials. Let me know what you think in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. And let me know what you think of Applied Materials. Do you own it? Is it in your portfolio? Is it one you're watching for a better price to add to your portfolio? I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So again, if you have a suggestion like Applied Materials, drop it in the comment section down below, and I'll try to work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.